So Chris is going to talk more about this. I'm going to give you a high-level picture. What I do, I'm in the financial services business. I've got a very unique approach. I help people that are currently losing money unknowingly and unnecessarily. And that normally triggers some kinds of feedback from the client. Again, Chris will talk more about this. One of our core philosophies is we believe we can help people more by avoiding losses rather than trying to pick winners. Okay? So avoiding losses that they experience in how they pay for their mortgage and how they pay their taxes and how they pay for education and major purchases and retirement, how they're paying those 5 major areas of wealth transfers, there is found money there. So the person that says, I don't have the money to do that, that may not be true. We can sit down and kind of educate them. Those are those 5 areas I just mentioned to you real quickly. So money. Money moves around the world in a single pool. Someone once said that 97% of the wealth is controlled by 3% of the people. That's pretty accurate. In fact, that 3% number is a little high. It's really a little lower than that. So someone once said, if you were to take all the money in the world, equally redistribute it, so every single person's got the exact same stack of money to the penny, that within 10 years, it would be right back in the hands of the 3%. Why? Because they understand the most important business in the world, and that business is banking. So another way that Nelson explains this is like water. Water can take a couple of different forms, ice or rain or whatever. That water condenses in a cloud, and it finds a stream, that finds a river, that finds an ocean, that finds the sun. It evaporates and repeats the process, and every 3 days or so, some of that better flow through me and you, right? Or else we're not here anymore. So that's the way water is flowing. In the same way there's only one pool of water in the world, there's only one pool of money in the world. And Nelson, the way he used to describe this is because the fact that it's denominated differently by countries is incidental. There's still only one pool of money. So these aspects of money must be true. It must flow from one party. In other words, a source. Right, Hatchet? It's got to be a source of money, right? From one party to another at a cost to meet a need. Those 4 characteristics of banking. From one party to another at a cost to meet a need. Okay? So the key is for you to become your own rainmaker. That's what you're going to help clients do. And if they don't have enough cash value in their plan by themselves, you're going to have the unique capacity, and y'all, we'll be one of the only firms in the nation that does this. Trust me on this. I'm with these guys all the time. I communicate with them all the time. We'll be one of the only firms in the nation that can connect individual policyholders together, and we can do it in a format that administratively it can make purchases possible by using other people's money. And both parties benefit. The group naturally separates into 2 different groups. What happens, Steve? It's kind of cool. One group are the folks who have been in business for a while and they've done pretty well with money. They have money. Another group are the young, hungry lions that are wanting to go kill something and drag it home. They need income. So this group naturally within your clientele becomes the lender to this group. What do they get out of it? Interest. They're going to charge interest. I'll go into all this and tell you more how it works. What do they get out of it? They get a private network. They get access to the money. They don't have to fill out a credit app. Lots of stuff. This is good. We all take just a second and jot this down, or take a picture with your phone, whatever's quicker. But financial success measures the attention you pay to the control of the banking function as it results to your needs. So you want to control enough of the banking function that your financial needs are met through privatized banking. An example is you need something that we're both the consumer and participant of. Nelson uses the example of the grocery store. So real quickly, a can of peas comes in the back door wholesale at 57 cents. It gets set on the shelf. You got to pay for the nice building. You got to pay for the air conditioning. You got to pay for the liability insurance. You got to pay for the parking. You got to pay for the marketing. You got to pay for all that stuff, right? It takes 3 cents to pay for it. So it goes out the front door at 60 cents, right? So peas come in the back door at 57, go out the front door at 60. That's key. You have to understand this. If you don't get this, you won't get infinite banking. So what has to happen is you as a client have to shop at your own grocery store. And everybody that loves you, why in the world would they go to Ingles if you own your own grocery store, right? So you need to have everybody that loves you shop at your own grocery store. And you end up having a captive audience. So if you turn it 17 times, that can of peas, you'll break even. If you turn it 20 times, you retire early, you've got a profit coming. 22 times, and that gives you a buffer, gives you wealth. So the key is to turning that can of peas 22 times. All of you, when you open a properly structured, participating, dividend-paying whole life insurance policy, a banking whole life through Emeritus, when you set this up, when you open it this way, then what you've done is you've just opened your own business. Okay? Every contract for us is a business. Why? Because it's a bank. We're using it as a profit center. So Nelson had 49 different profit centers. He used another example. He talks about steam, right? And he's like, you know, if you have hot water that's heated to 210 degrees, all you got's hot water. But if you can elevate it just a little bit more, y'all stick with me, this is so important that you get this. If you can increase the temperature just slightly to 212 degrees, now you've got steam, right? That's power. In fact, the steam engine changed the United States, changed the country, right? So what clients do is they'll have this uninformed idea that they're paying too much for their insurance. That's not true. Most of the time, they're paying too little. If they would turbocharge it and go out the front door and buy the can of peas retail at 60 cents. Buy it retail. In fact, if I'm coming to shop at your store, I'm invested in you, I love you, I'm probably going to pay 62 cents. You say, well, Scott, why would you voluntarily pay extra? Because that makes the system stronger, right? So we're going to throw everything we can. Nelson said, don't be afraid to capitalize your system. Don't be afraid to take assets that you have in your home equity, assets that you have in your 401k or IRA, your CD, your bank, your regular bank account, your savings account. Wherever you have assets sitting out there, don't be afraid to move it in, capitalize your account, right? That's steam. So by doing that, by opening this up, you're going to help those 10 at-risk families something else. They don't have access to Chris Pruitt. For the most part, sit down with an enrolled agent, sit down with a retirement specialist. Most of them can't do that. They can't afford it. In the back of their mind, they would never even try. So where do they go? H&R Block, right? They pay so much per form to have H&R Block try to do the service for them. That's what most happen. You get to help them protect against the greatest thief in the world, right? The IRS. So that's part of it. Ed, this is for you. In Nelson's book, you're going to hear from the legendary Ed Rush tomorrow. Ed, he's going to speak to you here in just a little bit. We're going to have you get your lunch when we're after Jim finishes. We're going to have you get your lunch and bring it back in here. Ed's going to speak to you during our lunch hour. But here's true fighter pilot, Top Gun graduate. He's a stud. So I'm a private pilot. I'm nothing compared to what he is. But as a private pilot, you can get in a Cessna 152. And these numbers are a little off in my opinion. They fly at about 100 nautical miles an hour. Okay? So it's going, you've got a little lawnmower in the sky. But it's real flying. In fact, you talk to a lot of pilots today that fly on autopilot, big jets. They really enjoy this kind of flying because you actually do something. You actually have the flight controls, right? So, but it doesn't have much capacity. Okay, so I'm going to come back to that plane here in a second and talk to you about the speed of the plane. There's something called the jet stream that moves from west to east in the United States. Right? It moves across the globe. It affects us west to east. That's high, fast-moving winds. They move at about 30,000 feet up in the air, and they're fast. Right? So if you get up there and you're fighting against the jet stream, it becomes much more difficult. The idea is not to fight against the jet stream, but to go with the jet stream, right? So you have a tailwind instead of a headwind. In fact, one of my friends of mine is in big in infinite banking. His company is named after that. So here's an example. This is me, or Ed. We get in a plane, and we're in Nelson's hometown, Birmingham, Alabama. Okay? And Nelson wants to fly to Chicago. And so he should be able to take off fly at about 100 miles an hour and make it to Chicago, right? But what happens is the jet stream blows in, right? So there's this weather system over the top of it. And it's actually blowing in such a way that he's got a 400 mile an hour headwind. So if his plane travels at 100 nautical miles an hour, but he's facing a 400 mile an hour headwind, guess which direction he's headed? He's going to Miami, fast, right? His plane may be pointing toward Chicago, but he's headed toward Miami. And all your clients are in the same boat. The financial environment that they're in, the financial atmosphere, is they're fighting against interest. They're fighting against financing. They've been taught that the smart thing to do is to be in perpetual debt. Go to debt to pay for school. First of all, most people should go to college, in my opinion. I think you could do better by going to a trade school. If you're in a career that has to have college, then finally go after it. But you go into debt to go to college. You go into debt to buy your house. It's called the American dream. Having a house with a debt, you never really own it, right? Just crazy. So the smartest thing for this plane to do would be to wait, not until it's over the center, over the path, because then there'd be no headwind. He's flying at 100 miles an hour, right? That's where most whole lives are. They're not funded properly, not facing the headwind, but they certainly don't have any help. There's no tailwind. But if you'll wait as a pilot until that system moves further to the east, so now you have a tailwind, now you've changed the economic environment for your client. And that could propel that 100 mile an hour Cessna much more quickly. Okay, so here's what most clients want to do. Can I squeeze a few more percentage rates in my rate of return? Can I do a little bit better? Well, I know that I have to take more risk to get a better return, but can I do that? So for the Cessna pilot, instead of trying to squeeze out 25 more miles per hour, that's nuts. It's insane for him trying to do that, right? He should just wait till the environment changes. That's what your client should do. The client should change their economic environment. If they do that, Jim, they can turn a headwind into a tailwind. Instead of them paying, ABC Bank interest and going backwards, they can pay their own banking system. They repay Emeritus for the loan. Emeritus is going to take 5%. You encourage your client to go out the front door, pay retail, pay yourself back at 7%, Marty. Then what the client's doing is the extra money goes back into their system, right? It actually pays the loan off faster. That's what happens in this. So instead of your clients trying to get another 2 to 5% rate of return, that's insane. You should help them change the economic environment. If you do this, we're not talking about an 8% average rate of return. Stock market's done a little over 7%, S&P 500, over a 20-year period of time. We're not talking about that. We're talking about avoiding a 34.5% headwind. So if I no longer have blowing me backwards at 34.5% in interest charges, that's interest volume, by the way, not rate. So Steve, my brother, we talk a lot about the difference between rate and volume. Everybody else, bank customers think interest rate. What's my interest rate? Can I get a better interest rate? Your bank account doesn't understand interest rate. Your bank account understands what it translates into. That's a payment, right? That's interest volume. So what Nelson teaches is focus on volume, the volume of money coming out of your personal economy. And it's staggering, 34.5%. 34.5%. So if your take-home pay is $100,000 a year, you're taking $34,000 and you're going, throwing it away. So just by changing the economic environment for you or for your clients, that $34,000 that you're throwing out the window stays in your personal economy. Y'all, that's a 34% rate of return. Okay? So creating a bank, what's it take to create a bank? $20 million for starters, a bank charter, 10 years of experience, all kinds of assets. It takes all those things to build a brick and mortar physical FDIC bank, right? But there's a better way that we can do it. It's been time tested for over 200 years. You've got to look at it. You can't have arrival syndrome and hear the word insurance and think, oh, I know what that is. That's not a good deal. You've got to get past that. If you can, y'all, I wish you could have Nelson stand before you. If Nelson stood before you, in 5 minutes' time, you'd think, this guy is a flippin' genius financially. And he would tell you all day long, this is the greatest financial workhorse ever created. A properly structured, participating, dividend-paying whole life insurance policy. Okay? When people first discovered electricity, they were sticking cord cobs in the outlet so the electricity wouldn't run out on the floor. It's the same thing people are doing with life insurance. They think they know what it is. They don't have a clue. It should have never been called life insurance. Should have, Keith? Should have been called death insurance, right? But you can't have ABC Death Company. I mean, that's not a very good name, right? Emeritus Death Company. But it should never have been called that. It's not life insurance, right? Anyway, I digress. So the world's greatest workhorse, I just told you about it. Every product starts with engineering. A car begins with a few lines on a piece of paper. Engineers and life insurance companies are known as actuaries. It's the only financial institution that employs such a person. They have a unique hybrid blend of an expertise in banking and money, finance, and the medical field. So they can tell you how many people out of 1 million people your age are going to die and when. Now, they don't know which people are going to die, but they know how many. It's called the law of large numbers. They've used it for 200 years. So they turn their information over to a rate maker. A rate maker then determines what to charge. Insurance is one of the few industries that looks beyond the next quarter. So for your clients that are doing mutual funds, that's a 90-day window. 90-day sprint. From 90-day sprint, think Enron. Okay? You've got to look impressive, right? I'm not saying all mutual fund companies are Enron. I don't mean that. But I'm just saying that's a short, tight window, right? Insurance carriers are 70 years out into the future. They're looking way further out in front. It's a unilateral contract, which means the company promises to do certain things. They're on the hook. All you have to do and all your client has to do is pay the premium. On the front of a life insurance contract, for those of you that have never read it, you need to read it. It says, Emeritus promises to pay. If they break that promise, everything that we're doing is worthless. They've been around for well over 100 years. They're mutually structured, which means the clients actually own the company, right? When you become a policyholder, you're an owner. You actually get a proxy statement where you can actually vote on stuff. So you take the premium payments, the company puts that to work, they give you this, they turn around and invest it. You as owner in the contract, you outrank every other potential borrower in the form of a policy loan. If you want to access the money, your number one priority to be able to access the money in the contract before anybody else gets it. You and your clients can borrow 90% of the cash value. The equity in your contract, you can borrow 90% of it out. The money never comes out of your contract. All the money stays in it. You take a policy loan against it. So all the money stays inside the contract. So Ed could talk to this much more intelligently, but if you have a big, heavy, fueled 747, 767, and it leaves LaGuardia and immediately has, and it's headed toward LAX, but it immediately has an IFE, an in-flight emergency. Something's wrong with the aircraft, right? And that plane needs to turn around and land. You know it's got to fly over the Atlantic for a little bit and do what? Dump fuel. You know why it's got to dump fuel? It's too stinking heavy, right? When you first start your contract, remember you opened a business from scratch. Every new account is a new bank that you just opened. It's heavy. You've got to burn off some fuel. Every year you have your life insurance contract, if it's properly structured, which means if you went through a Wellington advisor, it'll be properly structured, trust me. Then it becomes more efficient every single year. Every year it gets better. Nobody else has an investment like that where they know every single year for the next 100 years in the future it's going to get better. I mean, most people are speculating about whether a company will even be around then, right? This is Cyril Northcote Parkinson. He made the statement that a luxury once enjoyed soon becomes a necessity. If you and your clients can't beat Parkinson's law, then you won't win the financial game of life. You must beat Parkinson's. So if you get a pay raise at work, you get an extra $1,000 a month, and you get to the end of the year, and you don't see $12,000 extra in your IBC account, something went wrong, right? And what would most clients tell you? Well, you wouldn't believe what happened. This came up, and this came up, and I had this need, and I had this need. They really didn't, right? But they had 12,000 extra, so 12,000 went out the door. If you can't beat this, y'all, we're giving people advice that's so sound and practical. Live off less than what you make. Don't be stinking greedy about everything you do. Give money away. If you want to be wealthy, give it away, right? So we're teaching people very practical things. This is Willie Sutton. That's right, Uncle Willie. He was a famous bank robber. He was very polite and very well dressed. So if you were going to be robbed by a bank, you'd want to be robbed by this guy, right? So he was a nice dude. He was once asked, why do you rob banks? It's where the money is. The IRS knows where all the money is. Get it out. Why would you leave it in a 401k? That's insanity. You don't have to do that. You want to put it in an IRA? Why? You've got a partner. And by the way, that partner says, when it comes time, I'm going to take a piece. Well, Mr. IRS, how much are you going to take? I don't know. I'll tell you when we take it. Really? Yes, you're delaying two things. Listen to this. You're delaying the taxes on that account, and you're delaying the tax calculation. You don't even know what they're going to take yet because you don't know what tax law will be then. It's just insanity. So get your money out. Okay, this is the last slide. Everybody say, whew. Okay, this is what a bank does. Well, before I give you the punchline, you know what a bank makes on an average consumer with a balance between $10,000 and $100,000? You know what they make as a percentage off of your bank account? Can we give some money away? Let's give some away. Hold on. Let's see what we have. I'm going to let you do that other one. Okay? All right. $100. Gonna bless somebody. So, to the person that gets the closest, now if you see my presentation, you're disqualified. But to the person who gets the closest to what you pay the bank on average, if you have an account between $10,000 and $100,000 on an annual basis, guesses? Somebody remember these numbers for me.
35.
Renee, remember this. 15, what?
35%.
35?
45.
45?
65%.
65?
I say 12.
12?
22.
Okay, that's enough. Everybody remember what you guessed. This is Mark's money I'm giving away anyway. Okay, so here's what ends up happening. You deposit the money. They pay you maybe a point and a half. You want to buy, or they charge you, if you're going to go build a house, you pay 4% for that. An auto loan, you pay 8% for that. That goes to the dealer. Okay, so the dealer puts his money back where? In the bank. And when the guy, the home builder, when he takes your payment, where he puts the money back where? In the bank. All this money is cycling through the bank. What would happen if you're the bank? Right? Help a client who's never heard this before, an at-risk client, help them figure this out, right? Office improvements, you pay the general contractor, the contractor brings his money back to the bank, right? So you remember your number?
I just said 23% exactly.
Banking rule number one, you finance everything you ever buy. You borrow and pay interest or pay cash and lose it, period. Everything you ever do is financed. Number two, you can't steal from your own bank. If you borrow the money, for the love of God, pay it back. Help your clients pay it back, okay? Rule number three, banks got to be capitalized before they can function properly. Don't be afraid to capitalize. Help people move money out of the Dodd-Frank public regulated banking system where it's exposed. I'll talk to you next time about bail-ins instead of bailouts. Banking rule number four, money must flow from one source to another at a cost to meet a need. Those four qualifications for banking, there they are. Banking rule number five, you're limited only by your knowledge and creativity. Somebody mentioned this earlier, imagination. You must learn and implement leverage to maximize banking effectiveness. When you're set up in your local community as part of the person that built that $100 million umbrella, Gabe, over your community, when you're one of the people that sponsors middle income, normal people, and all expenses paid at 2 days at a resort, when you're one of those people, and you're one of those people, oh, by the way, in the process of doing that, I'm going to connect you with other amazing people like you because they have cash value too. And by the way, some of them would love to lend it. When you become that person, when you're the syndicator, when you're the hub, your value skyrockets. And last, banking rule 7, you must realize uninterrupted compound interest. Yeah, like Keith said, the money never comes out of your account. You borrow against it, not from it. So you need to realize compounding. And that's everything I got. Thank you.